Good morning, everyone, and welcome to our webinar, Knowledge is Power, What the PCAOB's Annual Broker-Dealer Inspection Report Means for You, hosted by PKF O'Connor Davies. All attendees are in listen mode only. Before we get started, I'd like to go over a few housekeeping items so you know how to participate in today's call. Following is a screenshot of the attendee interface, and you should see something that looks like this on your own computer desktop. You will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the webcast. We do have a lot of material to cover, and if time permits, we will make an effort to respond. If we cannot get to your questions, a response will be sent post-event. This webinar is eligible for 1 CPE credit. Please respond to the polling questions posed during the webinar. CPE certificates will be sent via email about 2 weeks post-event. A copy of the PowerPoint slides and a recording of today's webinar will be made available to you via email a few hours after the event. At the end of the webinar, we also have a very short survey, and your response is greatly appreciated. At this time, I would like to introduce Victor Pena, partner with PKF O'Connor Davies. Victor?
Thank you, Sandy. Good morning, everyone. I hope everyone had a fantastic summer. Now we turn to fall, which means audit planning season. Operating in such a highly regulated environment can present various challenges for broker-dealers. It's not a matter of if, but rather when the regulators will come knocking at your door. As many of you know, last month, the PCAOB published its annual report on the Interim Inspection Program Related to Audits of broker-dealers. The PCAOB had previously expressed that the overall observed deficiency rates in broker-dealer engagements remained unacceptably high. Despite the improvements noted in the 2021 inspection results, with notable exceptions, deficiency rates observed in 2022 inspections generally increased or remained elevated across the engagements types and areas. The broker-dealer team here at PKF O'Connor Davies has a dynamic mix of Wall Street, public accounting, and experience as regulators. Some of my partners whom you'll meet here today have a combined 15 years of experience working at the PCAOB and were integral to the design of the inspection program. Our goal from today's presentation is to help you better understand the contents of the most recent annual report from the PCAOB, how such audit deficiencies can turn into trouble for your broker-dealer, as these audit deficiencies may trigger unwanted attention from your regulators. My name is Vic Pena. I'm the broker-dealer practice leader here at PKF O'Connor Davies. Welcome to today's webinar. We are very excited to have you all join today's discussion on what the PCAOB Annual Broker-Dealer Inspection Report means for you. This will be the second event for the year of our Broker-Dealer Value Series. So let's get started and let's go over today's agenda. Next slide, please. First, we will give you an overview of broker-dealer audits and the firms auditing those broker-dealers, as well as engagements inspected. And second, we will dig into the meat and potatoes of the PCAOB report, where we will go over some of the areas of deficiencies of BD audits, where we will find the usual suspect areas like revenue, planning and risk assessment, related party transactions, and supplemental information. Lastly, we will discuss deficiencies in review engagements of the exemption report, deficiencies in examination engagements, and auditor independence findings, which tie right into deficiencies in quality control systems. So without further ado, let me turn it over to my partner, Harley Aronoff, and let's jump right into it. Harley?
All right, thank you, Vic. Welcome, everybody. Let's start big picture. Let's jump right on in. And first thing I want to mention to you is I spent 8 years at the PCAOB. I'm still bound by their internal code of ethics. So obviously part of that is I can't share non-public information. But the most important thing that I could share with you that I feel will be the most important thing for you to really take away from today, right off the bat, let's get started with it, is there's a rule called Rule 4004, PCAOB rule. And in that rule, it states that the PCAOB, as a result of their findings from their inspections of the audits of issuers and broker-dealers, if they deem it appropriate, if there's a rule violation or certain other things, the rule says that they will be required to notify the SEC, right? So why that's so important to you is because the SEC also oversees FINRA. And, point is, want to remind you, the regulators talk to each other, right? So it's important that everybody's on the same page, everybody gets this stuff right. So let's jump right on in and talk about some of the results of the 2022 PCAOB inspection over the audits of broker-dealers. All right, so first off, we'll see that in 2022, there were a total of 3,400 registered broker-dealers in the US. Now, there were, out of those 3,400, 305 accounting firms audit those 3,400, right? What I noticed that I thought you really want to point out that I thought you'd find interesting here, a few things. Number one is that 26%, as depicted on this chart, 26% of the accounting firms that audit BDs only audit one, right? And 59% of the total only audit 2 to 20, including none that hold customer assets, right? So how much expertise can they have? Certainly they can have expertise, but with respect to, the whole population of broker dealers, all the rules, industry, regulations, so on and so forth, I think it stands to reason that there's something to be said for having a lot more experience and expertise in the industry. All right, so last thing I want to point out here is there are only 14 accounting firms, or approximately 4.5%, that audit 51 or more broker dealers. And that includes the big four firms, each of them auditing over 100 broker dealers, right? So, you can see that there's a large portion of the population that are audited by firms that don't necessarily have a lot of experience. And then there's another group that certainly does have a lot of experience with it. All right, so let's take a look at the next part here. We're going to jump into the overview of the firms that were inspected. Okay, so what you can see here is that out of the 50 accounting firms that were inspected in 2022, there were a total of 18, or 36% of those 50 accounting firms that did not audit issuers, right? They don't audit public companies, meaning they only have broker dealers that they're auditing under PCAOB standards. The other thing is, of the firms inspected, 28 or 56% only audited broker dealers that claim an exemption from the customer protection rule, right? 44% of the inspections were of audits that included the examination over the compliance report. All right, so let's take a look at this, this next slide. We're going to look at the overview of some of the engagements that were inspected. Bear with me. All right, so we can see here that out of the 52, accounting firms, out of the 50 accounting firms inspected, there are a total of 92 audit engagements, right? So 50 firms, but some of them, they inspected more than one audit. So the total really of the 92 includes only 2 or 2.2% of firms that only audit one broker dealer. And then out of the total 92, it includes 29 firms, or 31.5%, that only audit between 2 and 20 broker dealers. So this, this is just another depiction of the, who's auditing who in the industry. And the last thing I want to point out here is that 35 of the 92 engagements that were selected were by firms that audit more than 100 broker-dealer clients, right? So a big portion of a lot of the inspections seem to have moved towards the bigger, more complex broker-dealers than in the past, but still pretty wide distribution across the industry. All right, let's move to that next slide. All right, so a big takeaway here, we can see this is the overview again of the firms that were inspected. And you'll note that in 2022, the PCAOB inspections like I just said, had a much greater focus on firms that audit both issuers and BDs, right? More complex, larger firms. So you'll notice here that there was 64% in the current year, whereas in the prior 2 years, it was 54% and 52% respectively. So, certainly slightly different approach that we've seen this past year. And, I think it's kind of simple what they're looking at. The broker-dealer program, many of you know, is currently under what's called a temporary rule, unlike the issuer inspection program. So that just ultimately means that the PCAOB still hasn't finalized it and come up with their final processes and how they want to go about inspecting, and whether there's some firms that will be exempt, some that won't, all that stuff. So under the temporary rule, they're still learning, they're still deciding how they want to go. So I think it's interesting that the question really becomes, where's the risk? And I don't know that we could draw conclusions from this, but once again, we could see this year the PCAOB started looking at a lot more of the bigger, more complex engagements and firms. All right, I also noted that the PCAOB only reviewed 52 audits of the 2022 audits, compared to 58 and 83 respectively, and that's since 2020. Kidding aside, it's not because Rachel and I left the firm, left PCAOB. I think there are obviously staffing shortages and whatnot, but I thought it was kind of interesting to note that they cut the amount of inspections or the engagements they inspect down pretty dramatically in this past year. All right, so the next slide is actually going to show you some of the deficiencies, and basically you'll see here that about 90% of the total that were reviewed includes either an audit or an attestation deficiency, right? So either some sort of deficiency where the audit, something in the audit didn't meet the engagement, the audit standards, or something having to do with either the review of the exemption report procedures or the examination of the compliance report procedures. All right, so that's pretty big. That's a pretty big number, obviously, and it's fairly consistent with prior years, a little bit higher, but there are little nuances why. So we'll get to that in just a bit. All right, so what you'll see here is about 58% of the total, or 53 engagements that were reviewed, had deficiencies in the audits, which was slightly down over 3 years. And once again, the 90% number jumped 12% over 2021 and 2022. All right, so the biggest takeaway here is that all the deficiencies identified right at the bottom of this chart, right? You can see the last two sections: examination engagement with deficiencies and review engagements with deficiencies. So I think the interesting thing here is that only 32% of the deficiencies were by firms that audit more than 100 broker-dealers and 100 issuers, whereas 73% of the identified deficiencies were coming from firms with seemingly less experience or complexity or expertise, right, in their audits and the industries they audit. And then lastly on this is that all of the deficiencies identified in the review engagements of the exemption report also, it also shows that there's a higher rate of deficiencies with less experience when just by looking at those numbers, right? You could see all the deficiencies and get that were found in the review engagements. All right, so now let's move over to some of these other observations on our next slide. And what we're going to see here is a little bit of a kind of maturing of the temporary inspection program of broker-dealer audits in the PCAOB realm. So you can see that in 2022, 86 of the 92 audits that were reviewed or inspected were based on risk-based selections. The other 6 were random selections. Okay? And no sense in even trying to guess. I can tell you from experience, don't waste your time. They were truly random, and but all right, let's I think what I really want to point out here on this slide that I think should be of interest to you is that these random selections, none of those 6, had examination engagements of the compliance report, right? There were clearly more deficiencies identified in the examination and review engagements where the auditor needs a little bit more broker-dealer industry knowledge of the rules and regulations. So, interesting that those random selections have an NA for the examination engagements, but we'll see if that changes in the future. Okay. All right. So those are some of the statistics that we're seeing summarized in the report that we're really going to start jumping into and take a deeper dive into. So with that said, we're going to jump to a polling question. Anna's going to get started on that. And just a reminder, the answers aren't something we share with everyone. Don't feel, just go ahead and answer. It's really more for our participation to keep track of and to provide you with CP credits. So Anna, over to you.
Thanks, Harley. So, yep, this is our first polling question. And just as a reminder, everyone should be answering these, and you'll be getting your CP certificates via email. So first question is, which of the following audit areas were cited by the PCAOB as having the most frequent rate of audit deficiencies in 2022 inspections of broker-dealer audits? Is it A, related party relationships, B, fair value measurements, C, revenue, or D, expenses and related accruals? Give everyone 30 seconds. So the correct answer will be B, fair value measurements, and 50% or 3 out of 6 audits were found to be deficient in the 2022 report. And it looks like a lot of you thought revenue, which is interesting, and that is actually our next topic. So let's get into talking about revenue. All right, so for deficiencies in audited financial statements and supplementary information, in this section, I'm going to talk about some instances noted by the PCAOB where audit firms didn't comply with the applicable standards in connection with their audits of broker-dealer financial statements and the accompanying supplemental information. And just one thing I want to point out, what we're going to talk about doesn't necessarily mean that the broker-dealer's financial statements were materially misstated. The PCAOB only has access to the BD's filings and any information that was retained by the audit firm. So they're only concluding on whether or not the audit was performed in compliance with the applicable standards. So just want to keep that in mind as we proceed. And the table on screen the table on screen summarizes instances of non-compliance with PCAOB standards. And it also shows comparative percentages for 2021 and 2022. So just a few things I want to point out here. First, you can see revenue is that top line on the table. And year over year, we consistently see a high sample for this area. And this year it had the second highest sample at 88. So we know the PCAOB is placing significant focus on this area in their inspections. In addition, 34% were found to have deficiencies, which technically is lower than the post-audit matters, which you see on the bottom there at 100%. And in the middle there, the securities owned, which by the way, was renamed from fair value measurements in prior reports, but that one's at 50%. And that was the correct answer for our previous polling question. But you can see that for those areas, the samples are significantly smaller. So revenue's got the higher sample. That's why the percentages are maybe don't actually align with what we would expect. And lastly, as it relates to revenue, 34% is down from 47% in 2020. So as an industry and in practice, we're making strides in that right direction. And part of that is why we're here today, so that we can learn and understand what changes we can make as we look to the future. So we can move to the next slide. All right, where did firms fall short? Well, the PCAOB noted that there were 3 most of the deficiencies related to the 3 that you see on screen here. And these relate to auditor requirements to first perform audit procedures that address assessed risk of material misstatement for all relevant assertions of significant revenue accounts and disclosures. So to put that more simply, firms either identified a fraud risk related to revenue, or maybe they did not rebut the presumption of revenue recognition as a fraud risk, but in either case, they didn't properly address the assessed risk in their substantive testing of details. Second, they did not plan appropriate audit samples. We're going to talk about sampling in a little bit, and coming up, we're going to have a polling question on this topic, so hopefully everyone can get that one right. And then lastly, they did not obtain audit evidence that is sufficient and appropriate. And then in addition to these three, there were also some deficiencies noted in other sections of the annual report for identifying and assessing risk of material misstatement and evaluating audit results. And those also involved revenue, so we're going to discuss those in another section as well. Okay. Where did firms fall short in responding to the risk? We previously talked about fraud risk related to revenue. So first, there were instances where firms did not perform any procedures for one or more significant revenue account. Many broker-dealers have various revenue streams and accounts, and so in the findings, there were some of those significant or material accounts that were simply not tested. We also talked a little bit about number two, firms did not perform procedures to address the assessed risk of material misstatement for one or more relevant assertions. And ultimately, for each significant revenue account, firms need to be addressing the assertions that we have listed here. Just go through them quickly. Existence or occurrence: has the recorded transaction actually occurred? For completeness, are all the transactions and accounts that should be presented actually included? Valuation or allocation: have the revenue components been included in the financial statements at the appropriate amount? Rights and obligations: does the broker-dealer control rights to assets? Are liabilities the obligations of the company at a given date? And presentation disclosure: specifically here we're talking about revenue disclosure, but are the components of the financial statements properly disclosed, classified, and described? Okay, next slide. Okay, so here we're going to talk about some deficiencies related to common sources of broker-dealer revenue. And the PCAOB actually gave us some examples of deficiencies that were noted over these specific accounts. For commissions, firms were not testing whether the commission recorded by the broker-dealer was accurate based on the terms of the trade, including price and quantity, and the applicable commission rate. For investment advisory fees, firms did not sufficiently test the amount of assets under management and whether fee rates were consistent with the terms of contracts with customers. As it relates to trading gains and losses, firms were not testing prices and quantities associated with security purchases and sales. For investment banking fees, firms did not sufficiently test the amount of capital raised and the rate used to determine fees, whether those transactions had occurred, and whether a performance obligation was satisfied prior to revenue recognition. And then lastly, for M&A or other advisory fees, firms were not sufficiently testing whether the merger or acquisition transaction had occurred and if the advisory services had been provided. So when I read all these findings in the PCAOB report, I see a common trend. And to me, I see regardless of the type of revenue, there was at least one or more aspects of the transaction that the firm failed to test. So how can we avoid this? I think the answer is that both parties need to work in unison, broker-dealers and auditors. Throughout the year, broker-dealers should be considering their audit trail from start to finish, what went into that individual revenue transaction. The auditor should and will ask for the related support, and the best way to get ahead of any issues is to plan for it before year end and just do a walkthrough of some of those transactions so you know what support needs to be provided and tested. Okay, we can go to the next slide now. All right, so a few slides back, I mentioned that there were some revenue-related deficiencies in different sections of the annual report. This one is for evaluating audit results, and these deficiencies specifically related to financial statement disclosures. In 2022, those deficiencies related to presentation and disclosure of revenue actually increased. So what happened? Well, the firms did not evaluate the presentation of the financial statements in conformity with ASC topic 606, revenue from contracts with customers. This included qualitative disclosures about the performance obligations. We know broker-dealers must include a disclosure on the performance obligation for each revenue stream. Underwriting revenue recognized prior to satisfying the performance obligation, and principal gains presented net of clearing expenses and other trading fees. In addition, firms did not evaluate whether revenue such as advisory fees that maybe were reported as commission revenue should have been disaggregated into separate categories. And according to the standards, revenue needs to be disaggregated into separate categories that depict how the nature, amount, timing, and uncertainty of revenue and cash flows are affected by different economic factors. But luckily, the PCAOB gifted us with some recommended action for firms, that firms should enhance procedures to evaluate the presentation and disclosure of revenue. So what does that mean? The PCAOB recommends that firms consider how revenue is first presented, and they should take into account how information from the broker-dealer's revenue was presented on the focus report when evaluating the selection of categories used to disaggregate the revenue. And then also firms should consider how revenue is disclosed, and that includes evaluating whether the broker-dealer disclosed information about its performance obligation for each individual business activity. Okay. Now I'm going to talk a little bit about some of the deficiencies found in substantive testing. First one is sampling. We touched on earlier. You probably remember that failing to plan an appropriate audit sample is one of the 3 most common deficiencies noted. And when planning a sample for a substantive test of details, some firms did not consider tolerable misstatement, the allowable risk of incorrect acceptance, or the characteristics of the population. One firm did not select a sample that was representative of the population, and another firm only tested revenue from one customer and then projected the results to the complete population. As it relates to audit evidence in testing, substantive testing of details, firms used information produced by the broker-dealer as evidence, which would have been acceptable had they tested the completeness and accuracy of that information, which is required by the standard. And that can be done one of 2 ways, either testing controls or testing the information itself, or it could be a combination of the 2. For materiality, when establishing the extent of substantive procedures, firms did not take into account materiality or the assessed risk of material misstatement. So the common theme here that we keep picking up on is that the risk assessment always should align with the planned procedures and the scope of testing, which is also driven by materiality. And then lastly, substantive analytical procedures. One firm performed substantive analytical procedures but did not perform a test of details in response to the assessed risk of fraud. So similarly, the risk assessment did not align with the planned audit procedures. So that wraps up revenue, and it brings us to our next polling question. This one's on sampling. So 2 auditors are testing the same population of revenue transactions. Auditor A judgmentally selects a sample of 100 to perform a substantive test of details. Auditor B uses a sampling calculator that considers the risk of tolerable misstatement, incorrect acceptance, and the results in a sample of 25 transactions. So which auditor would the PCAOB be expected to issue a comment to? Is it Auditor A, Auditor B, neither, or it depends? All right, I think everyone should have had an answer submitted by now. And the correct answer is Auditor A. And earlier we just talked about this, a deficiency where a firm did not consider tolerable misstatement and the allowable risk of incorrect acceptance or the characteristics of the population, which is required by the standard. So in this case, Auditor A failed to do so, and they would likely receive a comment form on this. All right, we're going to jump into planning and risk assessment. So we can go to the next slide. What went wrong here in identifying and assessing the risk of material misstatement? Well, firms did not perform sufficient risk assessment procedures in certain areas of the financial statement audit. More specifically, firms failed to do the following. First, they failed to sufficiently evaluate qualitative and quantitative risk factors related to financial statement line items and disclosures. So ultimately, they did not determine the likely sources of potential misstatements. They also did not obtain a sufficient understanding of the broker-dealer's internal control over financial reporting, which would include information systems, business processes, and control activities to identify and assess the risk of material misstatement and design further audit procedures. They did not identify and assess the risk of material misstatement at the financial statement level or assertion level, and they did not evaluate the design of the broker-dealer's controls intended to address an identified fraud risk and determine whether those controls had been implemented. So not only to determine that controls exist, but also have they been implemented and are they operating effectively? Next slide. Some firms missed the mark when it came to the consideration of fraud in a financial statement audit. One firm was found to have failed to perform fraud inquiries, which is required by AS 2110.54. And this is just an easy fix going forward. Firms have to make sure that they make those inquiries and document them as well. And then as it relates to journal entry testing, there were also firms that did not test a sample from a complete population of journal entries. So any testing performed over an incomplete population instantly fails to meet the audit standard. And we all know that ultimately it's the auditor's responsibility to plan and perform an audit to obtain reasonable assurance about whether the financial statements are free from material misstatement, either due to fraud or error. So step one is identifying the fraud risk, designing audit procedures to respond those risks, and we always must include inquiry with individuals involved in the broker-dealer's financial reporting process. So next topic will be related party transactions. Financial statement users rely on related party disclosures to help them form a view about the effects of such relationships on the business. So the PCAOB definitely places a focus on this area for that reason. And in the 2022 inspection report, the PCAOB discussed those failures in connection with the related party transactions. And here, firms failed to test the accuracy and completeness of data used to allocate expenses or revenues between broker-dealers and their affiliates. They failed to identify omitted disclosures necessary to understand the effects of related party transactions on the broker-dealer's financial statements, and that's in accordance with ASC topic 850, related party disclosures. They also failed to inquire of management regarding related party transactions and relationships, and they failed to take into account information gathered during the audit in evaluating whether the broker-dealer had properly identified its related party relationships and transactions. So with related party transactions, communication is really key. Known related party transactions should always be disclosed, and when there's transparency, ultimately there's going to be fewer questions and issues that are likely to arise over this section. So now I'm going to turn things back over to Vic, and he's going to get into it with supplemental information.
Thank you, Anna. Thank you for your insights. So let's discuss some of the findings associated with the supplemental information on annual reports, specifically the net capital computation as well as the customer protection rule. So let's start with net capital computations. During the last PCAOB inspection period, there were 41 audits where net capital was selected as an inspection area. In those audits, 11 of them had audit deficiencies. So that's approximately 27%, almost 1/3 of all audits inspected had a deficiency. A troublesome stat, to say the least. Clearly, the completeness of deductions and non-allowable assets was a recurring theme in some of the issues identified. Allowable assets and assets not readily convertible into cash, including deposits with and receivables from clearing brokers, commission receivables and deferred tax assets. Also, adjustments to net worth, specifically the addition of discretionary, subordinated, and deferred tax liabilities was highlighted. Minimum net capital requirements, including the exclusion of certain liabilities from aggregate indebtedness, deductions with respect to excess fidelity bond coverage, and securities haircuts was also identified. where firms did not perform sufficient procedures to determine if the adequate haircut was taken, depending on the type of security or position. Lastly, the firms did not obtain written representations from management of the broker-dealer. So that's a pretty easy fix, hopefully. As it relates to the customer protection rule, firms did not perform, or at least the PCAOB considered that firms did not sufficiently perform procedures to test the completeness and accuracy of information presented in customer and broker-dealers reserve computation, including information produced by the broker-dealers or the broker-dealer service organization used to prepare those computations. There's often a misconception that the information produced by the broker-dealer service organization is third-party information, and the auditor should accept it as vital to some extent. The standards make it very clear that the service organization is viewed as an extension of the organization, and as such, the auditor needs to perform procedures over the information that is going to be relied upon as audit evidence. Firms also did not perform or sufficiently perform procedures to evaluate whether customer reserve computations were determined in compliance with the reserve requirements rule, including whether accounts qualified as special reserve bank accounts. For possession and control, again, firms did not perform or sufficiently perform procedures to test the completeness and accuracy of information related to possession and control requirements for customers. Firms also did not perform sufficient procedures to evaluate whether information related to the possession and control requirements for customers was determined in compliance with the customer protection rule, including whether instructions to reduce to possession or control were issued for fully paid securities and excess margin securities. I also would like to point out, we recently had put out an article as there are some proposed changes to the frequency of reserve requirements. So if you are a type of broker-dealer that is non-exempt and is subject to reserve requirement computations, is something that you want to be watchful in monitoring, as you may need to evaluate what the impact would be if that frequency changes from weekly to daily. Lastly, the auditor's report on the financial statement and supplemental information. This one was a bit surprising to some extent, as the PCAOB still found issues with firms omitting or not properly presenting required elements in the auditor's report in accordance with ASC 3101, including the title of the auditor's report, the section title, opinion of the financial statements, or required elements from the opinion of the financial statement. In the section title, basis for opinion, as required elements from the basis of opinion selection of the auditor's report, and lastly, the tenure of the firm. So moving right along, let me turn it over to my partner and former PCAOB inspector, Rachel DiDio, who will go over deficiencies and exemption report reviews. Rachel?
Thanks, Vic and Anna, for covering the deficiencies in the financial statements and supplemental information. We'll now switch gears as I cover the deficiencies in review engagements regarding the broker-dealer's exemption report. Review engagements are applicable for exempt broker-dealers. An exempt broker-dealer is one which claims an exemption pursuant to paragraph K of SEC Rule 15C33 or footnote 74. A review engagement mainly includes reading the exemption report, performing inquiries and other review procedures, and evaluating whether evidence indicates there should be modifications to the broker's or dealer's assertions based on the results of the procedures performed. If you can go to the next slide. Thank you. In 2022, the PCAOB selected 52 review engagements to inspect and identified deficiencies in 21 of those, or 40%. This is actually an increase in the percentage of deficiencies identified in both 2020 of 23% and 2021 of 28%. So what are the deficiencies and how do they impact both the auditor and the broker-dealer? Next slide. Thank you. So the first deficiency was isolated to one firm which did not obtain a sufficient understanding of the conditions relevant to the broker-dealer claim of exemption under paragraph K1 of the Customer Protection Rule. The second deficiency relates to firms not evaluating evidence obtained in the audit of the financial statements that contradicted broker-dealer assertions regarding compliance with the exemption provisions claimed in the exemption report. So what does this mean? The inspection report provides an example of a broker-dealer claiming exemption pursuant to paragraph K2II. However, audit evidence obtained indicated that the broker-dealer transacted business outside of arrangements with the clearing broker. So, for example, the broker-dealer may have also effectuated transactions with customers through a bank account designated as a special account for this exclusive benefit of customers. If you joined us for the webinar we did earlier in the year, titled Regulator Red Flags, How to Avoid Common Financial Statement Errors, you'll recall that this is one of the more common red flags we come across, as the financial statements and disclosures typically include sufficient details on the nature of the broker-dealer's operations to understand the types of exemptions that you would expect to be claimed. I'm sure both the broker-dealers and auditors on this webinar know how important it is for the auditors to have a sufficient understanding of the SEC rules and regulations applicable to their clients. No one broker-dealer is the same, and the relevant SEC rules and regulations are quite extensive. It's critical that the broker-dealer engages an auditor that has the requisite knowledge and expertise in the industry, including an understanding of the exemptions claimed and how to evaluate compliance with the exemption provisions. As broker-dealers look to engage an auditor, it's always a good idea to get an understanding of the auditor's current experience and client base. As we touched on earlier, there are a number of firms that only do 1 or 2 broker-dealer audits and no issuer audits. That means that these firms' only exposure to PCAOB standards are their broker-dealer audits. It also means they may not have any experience with the types of exemption provisions you are claiming. Next slide. This slide discusses some other deficiencies identified related to the auditor's review procedures. The first deficiency relates to firms not making required inquiries. Paragraph 10 of the attestation standard number 2 details the various inquiries the auditors required to perform to identify exceptions to the exemption provisions. As mentioned at the beginning of the section, review engagement mainly includes performing inquiries and other review procedures. If the auditor doesn't perform the required inquiries, how can they obtain the understanding of the business they need to bring to management's attention any potential contradictory evidence to the assertions claimed? The second deficiency relates to one firm not performing procedures to determine whether customer checks received by the broker-dealer were promptly transmitted. Pursuant to the rule, promptly transmitted means by noon of the next business day. The receipt of customer funds by a broker-dealer can provide insight into the exemptions the broker-dealer should claim. Further, if customer funds are not promptly transmitted, it may indicate the broker-dealer should not claim an exemption. Any exceptions by the broker-dealer to the prompt transmittal should be included as an exception in the broker-dealer's exemption report and the auditor's review report. The last deficiency relates to one firm not obtaining a representation letter from management, which is required pursuant to paragraph 13, which expresses the auditor to risk. And I know that we had touched on this earlier. In addition, paragraph 18 states the auditor should not date the review report any earlier than the date on which the auditor's completed his review procedures. So what does that mean? Given obtaining written representation from management's a required procedure, the auditor should not issue an audit opinion until this has been received and should not date their audit report prior to. These next 2 slides cover deficiencies identified in the auditor's report, which I know Vic also touched on some of these. This slide discusses deficiencies related to firms not accurately identifying in their review report assertions made by broker-dealers in their exemption report. These types of deficiencies are often the result of the audit firm including in their review report the same assertions that the broker-dealer included. So that means that not only is the audit firm's review report inaccurate, but likely so is the broker-dealer's exemption report. Next slide. This slide discusses some other deficiencies related to the auditor's review report. I won't read these to you, but they're specific to the requirements within attestation standard number 2, paragraph 16 and 18. For the deficiency identified related to paragraph 18, again, we've already touched on this. An example would be the auditor dating the review report prior to receiving the representation letter. And with that, next, Harley will walk us through the deficiencies in examination engagements.
Great, thanks, Rachel. All right, so quick refresher before we take a look at this slide. Financial responsibility rules, right? What are they? 15C 3-1 from the Exchange Act, the net capital rule. 15C 3-3, customer protection rule, which includes the reserve requirements for cash and possession or control for customer securities. Then there's Rule 17A13, quarterly securities count. And lastly, the account statement rule that would be applicable to the broker-dealer. Typically, it's going to be the FINRA account statement rule if they're a FINRA member. All right, so with that said, what did the PCAOB identify with respect to testing internal controls over compliance and compliance tests over the broker-dealer that holds customer assets and doesn't claim an exemption from customer protection? So first thing we see here is that auditors failed to obtain a sufficient understanding of the financial responsibility rules that I just listed. Pretty difficult to get it right if you don't even understand the rules that the game is played by. Next thing that was found here is the firms failed to assemble a complete and final set of examination documentation, right? And I think most of us have heard, if not documented, it's not done. So pretty hard to really look your regulator in the eye when you don't even have documentation to show them that you did anything. All right, and then the last one here is a failure to obtain a sufficient understanding of the broker-dealer, right? I mean, once again, pretty important for all of us to remember that our regulators talk, and that means, in an odd way, the auditor and the broker-dealer are married, right? So an issue that's identified by a regulator of one entity could easily be communicated to the other party's regulator. And in my mind, the craziest part is the second entity could suddenly have conversations with their regulator, never even knowing the genesis. Well, why did you call me? How did this happen? Because they're never going to share that there was an issue at the other party that they work with, right? So lastly, plain English, auditors and broker dealers, you need to make sure you're working with the right companies, and you may want to make sure your auditors do the right job, and auditors want to make sure that broker dealers have their houses in order. All right, so let's move on to the next slide. Testing controls over compliance. So here, the big items that the PCAOB seems to identify year after year with respect to testing controls over compliance, two things. That one, auditors fail to either test or sufficiently test whether the information that's used and produced by the broker-dealer, where their internal controls depend on that information, whether that information is actually complete and accurate, right? So in other words, plain English again, let's say the broker-dealer is computing the reserve computation. First thing they want to understand is, what's the total amount of customer credits? How much do we owe customers? That's the starting point in our computation. They usually are going to take a report right out of their back office system and make sure the number that's on that report matches what's in the computation. Well, if the broker-dealer doesn't have controls to ensure that data, that report is complete and accurate, right off the bat, there's no way the auditor is going to be able to sufficiently, I should say, to opine on the fact that the controls over compliance are effective. All right, and then the other big deficiency, like I said, that the PCAOB seems to find here is really the sufficient testing and documentation for the auditor to demonstrate that they've effectively tested the broker-dealer's review controls over the computations, right? So end of the period, broker-dealer prepares the focus report, including the obviously net capital computation and the reserve computation if it's applicable. And that someone's preparing it, someone's reviewing it, and unfortunately, the auditors often either can't because it doesn't exist or don't actually test whether that information is complete and accurate. and whether it's occurred at a level of precision that would help the broker-dealer identify and investigate and hopefully resolve any issues that could lead to material noncompliance or noncompliance. All right, so let's take a look at the next slide here. These are really specific issues that were identified relating to 4 aspects of the financial responsibility rules. And let's start with the account statement rule. So there's been a pretty common theme where firms fail to test or sufficiently test whether the required customer account statements are delivered and whether they're complete and accurate, right? So whether complete and accurate account statements are delivered, whether it's electronic version or the paper version. And so it's a big problem. I'd hate to find out that, you know, my broker dealer doesn't even know if my account statement's complete and accurate. And then the next part, reserve requirements. What the PCAOB is seeing here is a failure to sufficiently test the controls, the broker dealer's controls, to ensure that the credit balance they use in the reserve computation is the right total. So kind of like I mentioned a moment ago, if the report they use is simply, you know, they take the number right off that report, the broker dealer has to have controls to help them ensure that those reports are complete and accurate. All right, next one is possession or control. And here the big issue is that auditors are failing to identify any controls over how the broker-dealer identifies segregation deficits and whether there's a sufficient resolution and a timely resolution based on the required actions of each specific type of deficit, right? So whether resolution's occurring timely and properly. And then the last one here is Rule 17A13, the quarterly securities count. Believe it or not, the PCAOB saw one firm that didn't test whether the customer's securities that should have been in their possession or control I guess in different states, failed trades, that type of stuff, whether those transactions, whether those securities actually exist, right? They didn't verify that. So, I mean, once again, imagine how scary it is. You know, all of a sudden you open up the Wall Street Journal one day on your way to work and you see your broker-dealer's name headline that the auditor never tested whether your securities even exist, whether they've been protected. You know, scary stuff. Fortunately, I identified only one firm that the PCAOB inspected. All right, so now let's move over to the compliance test, right? So we just spoke about test over controls, internal controls over compliance. Now let's talk about in the next slide, the compliance test. And that is the test over the net capital computation and the reserve computation at the year-end date of the broker-dealer, the last fiscal day of the year, okay, which are the same computations that would be presented in the supplementary schedules attached to the financial statements. All right, I don't see that the slide has been changed. I want to make sure we do that. Okay. All right, so let's go to all right, there we go. Thank you. All right, so here, once again, pretty common theme. Firms either didn't test or failed to sufficiently test completeness and accuracy of information produced by the broker-dealer, right? Whether right from the back office system or manually created, it needs to be, the broker-dealer needs to have controls to ensure completeness and accuracy, and the auditor needs to be able to have a basis for relying on that information as being complete and accurate, okay? So one note here, I can tell you from experience, I've heard a lot of broker-dealers and their auditors have conversations that sound something like, well, our back office system, that's why we pay them to get it right. So, we're comfortable that it's complete and accurate. That may or may not be true, but the audit standards require that the auditor do more than just, take your word for it, obviously. So there's a whole lot that goes into it. So just want to point out, auditors, hopefully understand how your broker-dealer works and how you operate. But sometimes they're still going to need to get more evidence than you're going to be able to provide. That's definitely something, as was mentioned earlier by Rachel, where you and your clients, the broker-dealer or the auditor, really want to be on the same page and open communication and be transparent as much as they could to be able to know what each other's looking for to make things as efficient and effective and painless as possible, right? So being able to say to your auditor, here's how we know what I'm about to give you is complete and accurate, right? That's going to be a great place to start, critical. All right, so now let's move on to our next part here. Let's jump into a polling question. All right, so polling question is, which of the following is not one of the financial responsibility rules? So is A, 15C3.1 one of the financial responsibility rules? Is 15C3-3 one of them? C would be regulation T margin. Is that one of the financial responsibility rules? D, 17A13. And lastly, the FINRA account statement rule, whose number is ever changing as they make adopt different amendments. But anyway, the FINRA account statement rule. So I'll give everyone a moment to respond. And once again, make sure you get those in so we can track your participation for your CP credits. All right, so the correct answer, good part, big, probably about half of us got this. It's regulation T margin. That's a Federal Reserve rule on the rules around borrowing money from the broker dealer to use to purchase securities or actually sell securities too, but to transact, to effectuate securities transactions. Right? So that's not one of the financial responsibility rules. It's obviously a very important rule, but it is not one of the financial responsibility rules that the auditor would have to test the internal controls over. Okay? So important to know, if your auditor starts talking to you about testing margin and your controls over margin and your processes, you could stop them right there and say, maybe they got a reason or not, but please help me understand why you're testing controls over regulation T and our margin controls. All right. Okay, so let's move on to our next part, which is auditor independence findings. This is a really big one. It's such an easy thing to get right, but it's also unfortunately something that often gets overlooked. But the SEC is very clear on this, and I can tell you, I've heard straight out of the SEC's mouths, we don't want the auditor to even staple and bind the financial statements for the broker dealer. Hand them the audit opinions or the attestation opinions, and that's it. Let them put it into their financial report and file it with the SEC and FINRA. Okay. So in this case, the PCAOB years ago, beginning of the PCAOB's broker-dealer inspection program, which I guess was in 2012 through 2015 or so, I remember there were just almost like daily, we'd hear about findings from PCAOB inspections where auditors were helping broker-dealers prepare financial statements in some way, shape, or form. And that, once again, we could see here, really has been rectified and subsided because only one of the firms that was inspected was found to have assisted in some way, shape, or form in the preparation of part of the financial statements. Okay? So certainly getting better, but just want to remind everybody, broker dealer, we'd love to, auditors would love to be able to, help do as much as we could to help. Certain things we're just not allowed to do, right? And it's better for all of us that we don't. All right, so let's, I'm going to hand this over to Rachel, and she'll start talking about deficiencies in systems of quality control.
Thanks, Harley. I know we are coming up on time, so I will get through this pretty quickly, so just hang in there. It is the last section for us. So this slide highlights the aspect of a firm's quality control systems which were deficient. As you can see, 54% of firms had deficiencies in engagement performance. Only 4% of firms had deficiency in monitoring, and only 2% had deficiencies in independence. Next slide. The Next two slides summarizes the engagement performance deficiencies. This one highlights the firm's failure to establish a complete and final set of audit and attestation documentation. It also highlights the firm's failure to document their audit and attestation procedures in a manner that would enable an experienced auditor having no previous connection with the audit engagement to determine who reviewed the work. In addition, it also highlights the engagement partner's failure to review and supervise the audit and attestation engagements with due professional care, as evidenced by those deficiencies in those engagements that we've discussed, throughout this section. Next slide. So this slide highlights the deficiencies related to a firm's engagement quality review. So PCAOB standards require what's called an engagement quality review to be performed, which is often, a second review. The objective of that engagement quality reviewer is to perform an evaluation of the judgments made by the engagement team, the related conclusions reached informing the opinion and overall conclusion on the engagement report. So the deficiencies highlighted that one firm did not establish any policies or procedures regarding engagement quality reviews. So basically that means they likely did not have one performed. For the firms that did have policies and procedures established for engagement quality review, the errors were the engagement quality review wasn't performed, so they had the policies and procedures, still wasn't performed. And the other ones were deficiencies in the engagement quality review. So, certain errors or omissions were identified in the financial statements that wasn't captured by the engagement quality review. Same with some of the deficiencies in the audit and attestation engagements. Next slide. And I'll just leave this slide here for everyone for a couple of minutes, but it basically just highlights the engagement quality deficiencies by types. So all engagement types, the deficiencies have actually increased since 2021. And next slide. And so this slide covers the monitoring and independence, integrity, and objectivity deficiencies. Identified monitoring, it was specific to, they identified that firms did not perform internal inspection procedures or alternative procedures for broker-dealer audits and attestation engagements. And again, I know Harley already touched on independence. So this sort of highlights that one firm did not establish policies and procedures to, again, provide reasonable assurance that the independence requirements with PCAOB and SEC standards and rules and regs was adhered to. So again, when looking to engage an auditor, similar to obtaining an understanding of the auditor's current experience and client base, it's also a good idea to ask them about, any recent enforcement actions or any last, their inspection and the results. And with that, I will pass it back to Harley for our final polling question.
All right, thanks, Rachel. Thanks, Rachel. Sorry, Anna, you want to go ahead?
No, it's okay. Sorry, go ahead, Harley.
PCAOB inspections and inspection findings have no impact on broker-dealers. Is that true or false? So hopefully everybody gets that. Give you a moment. Why don't we move to the end? I know that I'm going to hand this over to Anna and for some closing remarks.
Yep, thanks, Harley. So this brings us to the end of our presentation. I just want to thank Vic, Rachel, Harley for your participation and for providing your insights. And a big thank you to everyone who joined us today. I'll just take a quick opportunity to give you a little background on our firm. PKF O'Connor Davies, we are a national audit, tax, and advisory firm. We were established in 1891. We are PCAOB and SEMA registered, and we have 1,500 professionals across 17 offices. In addition, we are part of the PKF International Network, the 15th largest global accounting network in the world. So within our financial services and broker-dealer group, we have professionals with regulatory, Wall Street, domestic, and international Big Four accounting auditing experience. And we look forward to and are committed to providing insights throughout the year to the broker-dealer community. If there's any specific questions or matters that perhaps you would like clarity on, please reach out to us. Don't be a stranger. You're going to be receiving a short survey prompted at the close of the webinar. So please remember to complete that. And for your reference, a recording of this webinar and PowerPoint will also be made available to all attendees via email within the next few hours. So please, I know some of you might have submitted some questions. We kind of ran out of a little bit of time here. So if there's any specific questions, we'll look through and get back to you directly. So on behalf of our team, thank you again, and we hope you have a fantastic rest of your day.